we just thought that we'll do a quick recap of the year gone by, and we'll also touch upon what are the key factors on the macro side which are important, and how do we more importantly look at portfolio construction in the current environment. So the year gone by was marred by a range-bound Nifty from 15,000 to 18,500. The markets managed to close up marginally higher, close to 4% gains for the headline index. What we have seen is mid-caps were closer to the headline index gains, but we have seen a fair bit of divergence in terms of returns, both in terms of small cap underperformance for the year gone by. Small cap indices have underperformed the larger Nifty by close to 15 to 18% in the year gone by, and it has been a year for consolidation in a global turmoil environment for a lot of these small cap companies. On the sectoral performance, we have seen IT and healthcare underperforming. We have also seen realty underperforming. In terms of sectoral performance, PSUs, financials and consumer staples outperformed in calendar year 22. Inflation environment has been very elevated. The year has been marred by global supply chain disruptions, which have obviously impacted the cost curve of many companies. Supply-led pressures have reduced substantially as we get into calendar year 23. More importantly, the key for India is going to be stabilization of the energy prices, which is very critical for the Indian economy. What we have seen is that we have seen a gradual easing of energy cost in this environment. Hence, we believe that we are going to be in a sticky inflationary environment for the coming year. On the central bank policy action side, what we have seen is that the Fed continues to raise its projected rates to a 5% terminal rate. Obviously, inflation outlook has been a key agenda as far as the Fed is concerned in a very tight labor market environment. But we seem to be headed into an environment wherein higher rates for longer is going to be a key theme. As a conjunction to this theme, we have seen last year a lot of the growth stocks underperforming massively in this environment. Value as a style will continue to do well, and that is what we believe. As we see normalization and this margin pressure come off for a lot of these companies, gross margin should return to normalcy. As a result of that, we also expect EBITDA margins to result to normalcy, and that is where we see a lot of opportunity in terms of stock picking. In terms of Indian economy, we have a very favorable medium-term outlook on the economy, which is obviously driven by the policy environment, which continues to be very supportive and conducive, which is driven by a positive impact of the PLI scheme, opportunities arising from global supply chain realignment, which has favored India, and more importantly, which has favored manufacturing in India, driven by the Make in India program. And government's infrastructure spend should accelerate in the coming year ahead of the elections. Further, to dwell into this, what we have seen is that the private sector capex should pick up going forward. What we have also seen is that the corporate leverage is very low at this point in time. The capacity utilization is steadily rising, and broad-based economic recovery can be seen, which should lead to improvement in profitability, which is also already started to reflect into numbers. What we have also seen is the balance sheet of banks driven by a very good environment of high capital adequacy ratio should support this credit demand going forward. In terms of the major risks, obviously India continues to be a market which is slightly expensive. We are trading at one standard deviation above mean. We are trading at 19 times forward earnings. In this environment, it would be very critical that we have a earnings growth trajectory in that 15% odd consensus number which is getting forecasted after a 40% corporate earnings growth which got reported in FY20 to what we expect going forward is that the multiple of the market has some risk, but as long as we are in a steady state earnings growth environment, this multiple and this premium that India enjoys is going to stay. So that gives us a very good opportunity to build portfolios from a near-term perspective in terms of our overweight positioning on sectors which have underperformed in the last calendar. We like IT, ES and healthcare as a theme in terms of portfolio positioning. What we also like in this environment is the sectoral divergence between small cap and large caps, as I reiterated earlier in my call. So this is going to be a very constructive environment for bottom-up stock picking. Headline index expectation should be moderated at this point in time, but stock portfolios should do hopefully reasonably well over a 12 to 18 month period. Thanks a lot.